Another aspect of RRSPs basically is that you can buy what's called a spousal RRSP. So for example, if you're married and you are the sole earner, let's say, and your spouse is a stay-at-home spouse, minding the kids, whatever the case may be, whatever, therefore they have no earned income. Obviously, if they have no earned income, they can't buy an RRSP. Because if you remember, the formula is very clear. It's 18% off earned income. So you're a stay-at-home mom or you're a stay-at-home dad, so 18% of zero income is earned income. It's still zero. So how do you make sure that your spouse also has some kind of a pension at the other end? You do not have to put all of your RSP contribution into your own plan. You could, in fact, put all of it or a portion of it or whatever into your spousal RSP. So basically what happens here is that the spousal RSP is funded by the spouse who has the earned income or has contribution room. Okay, so that's contribution room. In other words, if I have the earned income, I've got contribution room, let's say, that I've never used, whatever, if you recall our previous example. In other words, I got space here that I can do something with. I can do two things. I can take the entire $37,000 in our previous example and put it all into my plan or something, or I can take the entire $37,000 and put it into a spousal plan, or I can basically split it half and half, or whichever way that I want. So the whole idea of a spousal RSP basically is what we refer to as income splitting. And the purpose of income splitting really is to reduce the taxes. That's the main thing. So if I am the main breadwinner, let's say, so I'm in a 50% tax bracket, but you're a stay-at-home parent, basically my spouse, and you don't have any income and everything else, then it obviously makes sense that there's some way that I can move money from my top rate, marginal rate, let's say, to your lower tax rate. It'd be wonderful if I could do that kind of stuff. Well, with the spousal RSP, you can do that exactly that. Okay, so I can take my earnings and I can move my contributions from my plan over to your plan. So instead of putting all that money into my own personal RSP, I can simply take all that money and put it into your plan, or half of it, or whichever way that I want. Okay. The other thing, besides reducing taxes, is clawbacks. You'll recall that I said to you that the old age security plan, OAS, for example, there's a threshold. There's a threshold. So roughly around $73,000, $74,000, let's say, is your threshold. And any amounts of money that I make above that is going to be clawed back at 15%. Okay, so therefore my OAS will be clawed back at 15% for every dollar that I make above that income threshold. Okay, so if I'm making $118,000, then basically, if you do the math, you'll see that I don't get an OAS. I lose the entire OAS because I'm well over that threshold of $73,000 or $74,000. But what if I was able to take some of that income now, move it over to you instead, and so now we're still getting, let's say, all that money coming into the family, but you're getting less than $73,000, I'm getting less than $73,000, so we both get OAS, so we don't lose that OAS. Whereas if I took all the income and I'm making now, let's say, $120,000, okay, well, at 118, the OAS is finished, so therefore I've lost the OAS privilege. But if I could take that 120,000, give you 60, and he keeps 60, now I'm well below that 73,000. I get OAS, you go OAS, and so therefore it just makes all the sense in the world. Okay, so therefore, basically, the two biggest reasons why we use a spousal RSP is income splitting, basically to reduce your taxes and also to reduce the possibility of OAS clawbacks. That's in a nutshell. Okay, now the contributions that I have made on your behalf, it doesn't reduce, okay, the contribution room for you, okay, so there's no effect on your spousal contribution. So let's say you do have earned income and you got 18% off whatever it is that your earned income. So you have your own personal RSP. This is a spousal RSP. And so therefore, whatever amounts of money that I actually put in there has no impact on your own individual RSP. So you don't have to worry about if I'm making a contribution to your RSP, that means now it reduces how much money you can put away. If you've got earned income, okay, then you go ahead, you do your 18% income and so on, and you make your own contribution to your personal RSP. The spousal RSP is really my money going into your plan, okay? And so it will reduce the amount of money I can put into my plan because I still have that limitation, remember? I still have that limitation. So I cannot put any more than that. However, the law does not say that I have to put it all into mine or all into yours. I can do it in between. Okay, so as long as I don't go over that line, I'm okay. So my contribution to your spousal RSP reduces the amount of money, obviously, that I can put into my own plan, but it will have absolutely no effect on your RSP contribution. So you're safe. Now, so far so good. Everything is wonderful. There is one big caveat, okay? One big thing that you have to remember. And that's what we refer to in the Income Tax Act as what we call attribution rules, okay? There's attribution rules that apply to this. So let me give you an example without getting too technical in all this. Let's assume for a moment, okay, so in other words, this section we talk about the disadvantage. Let's assume for a moment in 2013, I put in $10,000 into the spouse, into your RSP. 2014, I put another $10,000. 2015, another $10,000. In 2016, another $10,000, basically. Okay. So I put in every single year for the last 4 years, basically. I have put in $10,000 at a time. You decide one day that you're going to collapse the whole thing. Okay. You've had enough of this. You need the money, whatever. Or we are now separated, divorced, whatever it is, and you decide I'm just going to collapse the entire pension plan. The question now comes down to is how much of this $40,000 will be taxed back to the contributor and how much will be taxed into your hands, okay, because it is a spousal RSP. Well, under the attribution rules, you don't pay the entire amount of tax, okay? What happens really is that if the spouse withdraws within 3 years, okay, any contributions that have been made within 3 years, basically, so in this case here, within 3 years, is $30,000, is attributable back to me as the contributor, okay? So you still get the check. You're still going to get that $40,000. That's not an issue. So you get the check. That's fine because it is your money now. Once I put that money in, it is a spousal trust, and that trust is in your name, and I have no legal right to that money. It is your money. So that's fine. The problem comes down to is that any amounts of money that you withdraw from the year of deposit plus 2 years, in other words, maximum 3 years, basically, from the year of deposit plus the end of the second year. Okay, any amounts of money that you withdraw will be attributable back to me as the contributor. So you got the money, but I get the tax bill. That's basic in a nutshell. Okay. So in this example here, these 3 years here would be attributable back to me. So even though you got a check for $40,000, you're only going to get your $10,000 will be taxed. Okay, because that's beyond 3 years. So that $10,000 a year, that will be that will be taxed. Okay, into your hands. Okay, but the $30,000 basically will be taxed back into my hands. So even though you got the money, I end up getting the tax bill. So it's very important that when you make these kind of contribution and everything else, as I always say, make sure that your spouse recognize the fact that any kind of withdrawals they make within the year of deposit plus 2 years, in other words, maximum 3 years, that income will be attributable back to you as the contributor, basically. So it could hurt financially. So you got to be very, very careful when you do that kind of stuff there. But outside of that, it is an excellent way of splitting income, reducing your taxes, avoiding clawbacks and everything else. So the spousal RSP is still a very, very good way to actually split income between married couples and everything. And we'll see you next time.